one of the reasons that we got a big drop in gold prices on Friday. It wasn't just in reaction to the stronger than expected non-farm payroll number, but the surprise announcement from China that they took a break and didn't buy gold for a month. And the markets overreacted to that announcement as if the Chinese were done buying. I think that the big buyers of the week were the Chinese. I think the Chinese were able to take advantage of the fact that the market sold off on the news that they weren't buying gold in May to buy a bunch of it in June. And in fact, they're probably going to end up buying more gold in June than they would have bought in May. But because they announced that they didn't buy, they created a sell-off, which they were then able to take advantage of. Now, whether they were smart enough to figure that out in advance, to think, hey, why don't we just stop buying for a month, and then we can tell the markets that we didn't buy, and then the markets will jump to the wrong conclusion that we're done buying, and then we can really step it up. Because I think that the Chinese wanted to back off a little bit. I mean, they've been buying for so many months, and all of a sudden gold spikes up to a record high. It makes sense that they'd want to just back away a little bit.
Did you know the Chinese government might be manipulating the gold market to crash the US economy? According to Peter Schiff, China strategically paused its gold buying, triggering a market sell-off, and then swooped in to buy even more at lower prices. This cunning move not only disrupts the market, but also threatens to undermine the US dollar's value, leading to inflation and economic instability. Imagine the implications. As China continues to amass gold, the US dollar could weaken, eroding your savings and increasing the cost of living. Schiff warns that this manipulation could create a perfect storm of financial chaos, leaving many unprepared for the fallout. As the Chinese government exploits these market dynamics, the US economy could face unprecedented challenges, with prices skyrocketing and economic uncertainty growing. The strategic buying and selling by China could mean that your hard-earned savings lose value rapidly, making everyday goods and services more expensive and straining your financial stability.
The Fed acknowledged, or Powell rather acknowledged, that the inflation numbers are going to get a little worse before they get better. Right? So if that is the case, why is he still dangling these rate cuts in front of the market? Because if inflation is going to get worse before it gets better, what if it never gets better? What if it just keeps getting worse? And in fact, if the Fed is going to signal that policy is going to ease, if anything, it's going to ensure that that inflation problem that gets worse before it gets better doesn't get better and just continues to get worse. So while we got the weaker than expected inflation numbers, we also got weaker than expected economic data. And that combination really should have sent the dollar falling and gold rising. Gold did rise, but the dollar rose as well. In fact, the dollar index closed out the week very strong. It was back above 105. It looked like it was really starting to weaken the morning prior to the Fed announcement, after we got that lower than expected CPI. But the weak economic data should have really helped. But I think because Powell was not nearly as dovish as the markets had hoped, and also I think there was also some concerns, political concerns building in the Eurozone that helped to cause some dollar buying. But on Thursday, we got the weekly jobless claims, which really spiked up to 242,000 weekly claims. That was the largest number in quite some time, and it was way above the consensus estimate of 222,000 jobs. And the 4-week moving average now moved up to 227,000 jobs. So again, more evidence that the labor market is cracking, despite the positive spin on the jobs data that came out Friday of last week, a week ago. I went over that already, that beneath the surface, and not even deep beneath, just right beneath a very superficial veneer, was a lot of evidence that the labor market is in fact weak. And these weekly jobless claims support that. But also today, we got the consumer confidence numbers that came out much weaker than anticipated. This is consumer sentiment for June. And the consensus was for an improvement in sentiment from 69.1, which is where it was in May, to 73. And instead of going up to 73, the index plunged all the way down to 65.6. That is a massive miss. In fact, the lowest estimate out there was 70. The expectation was 70 to 75. 65.6 is an enormous miss. I think that's the lowest consumer sentiment has been of the entire year. You have to go back to late 2023 to get a number that low. This is really a repudiation of so-called Bidenomics, right? This is, the sentiment of the electorate. This is a huge drop. And in fact, inflation expectations went up from, or actually they didn't go up, they held steady at 3.3%, but the anticipation was for an improvement. And it's high inflation that is part of the reason that consumer sentiment is so low, because prices have moved up so much. And even if the rate of increase diminishes, it's still adding insult to injury, because prices that have already risen a lot are still rising. But the interesting thing is that even though gold itself recovered everything that it lost last week, the gold mining stocks didn't recover any of last week's losses. In fact, the GDXJ actually added to last week's losses, not by a lot, but it was still down. So in other words, a 1.75% rise in gold caused a 7% plunge in the GDXJ. Yet an even larger increase in the price of gold didn't result in any increase in the price of gold stocks. Instead, they fell even further. And so what is that telling you? Because gold itself hasn't really gone anywhere. And in fact, it's holding steady at a high price. It just shows you how negative the sentiment is in the mining sector. And I have been pointing this out. This is a massive wall of worry. Even the bulls, even the gold bulls don't believe the market, at least the bulls that are investing in the mining stocks, because they're so scared. When gold goes down, they run for the hills. And when gold goes up, they have no confidence in the rise because they're worried about the next decline. So you didn't see the recovery in the gold stocks to the degree that you saw the carnage. When gold was going down, people got so scared. And this, I think, is an extremely bullish factor because you don't have the strong sentiment. It is the ultimate wall of worry. That's why I've been saying that you can buy gold stocks and gold as a contrarian, even though the price is hitting record highs, because nobody believes the rally. We're not that far off from record highs in the price of gold. Yet we've seen a substantial correction in the price of gold stocks, even though we've barely declined in the price of gold. And if you notice what's been happening in gold, it keeps making higher highs and higher lows. Yes, we get corrections when we make new highs, but those corrections don't, go down that far. So the market is consolidating at higher and higher levels as the buyers have to keep paying up to buy gold. And the people who are waiting for a return to lower prices may be looking at a prior low and thinking, okay, let me just try to buy a retest of that low. They don't get it. If you want to buy gold, you have to pay up. You can get a pullback, but the pullback is not going to give you comfort of being a prior low. You have to be willing to pay a higher price to get into this market because it is a bull market. But when it comes to the gold mining stocks, you get plenty of opportunities to buy those cheap because the people buying the gold mining stocks still don't understand how powerful this bull market is, because I think it's being driven in large part by central banks. And as I mentioned, one of the reasons that we got a big drop in gold prices on Friday, it wasn't just in reaction to the stronger than expected non-farm payroll number, but the surprise announcement from China that they took a break and didn't buy gold for a month. And the markets overreacted to that announcement as if the Chinese were done buying. I think that the big buyers of the week were the Chinese. I think the Chinese were able to take advantage of the fact that the market sold off on the news that they weren't buying gold in May to buy a bunch of it in June. And in fact, they're probably going to end up buying more gold in June than they would have bought in May. But because they announced that they didn't buy, they created a sell-off, which they were then able to take advantage of. Now, whether they were smart enough to figure that out in advance, to think, hey, why don't we just stop buying for a month, and then we can tell the markets that we didn't buy, and then the markets will jump to the wrong conclusion that we're done buying, and then we can really step it up. Because I think that the Chinese wanted to back off a little bit. I mean, they've been buying for so many months, and all of a sudden gold spikes up to a record high. It makes sense that they'd want to just back away a little bit and let the market breathe, let it pull back, and then resume their buying. And in fact, as I said in my last podcast, contrary to the way the markets reacted to this news, I think it's very good news that gold made a new high without the Chinese buying. Because a lot of people thought, well, maybe it's only China, right? China's the driver of this rally. They're just one of the buyers, because even though China didn't buy at all, we still made new all-time record highs. And so I took that as a bullish indicator, not a bearish indicator. But one of the reasons I think that you saw such a strong gold market during this past week is because the Chinese resumed their buying. But it's not just the Chinese that are buying, it's all these emerging market central banks that are buying, because they understand what's going to happen with the US dollar. They understand what's going to happen with fiat currencies in general. And so they want to do what they can to diversify their reserves out of paper into real money. And so they're buying gold. And of course, the most over-owned fiat currency, the fiat currency that represents the lion's share of reserves, are US dollars. And so to the extent that foreign central banks are going to buy gold, they're going to pay for it disproportionately with US dollars, which is why ultimately the dollar has the most to lose. And in fact, since the dollar just rose against other fiat currencies, that gives the Chinese an even greater incentive to use those dollars to buy gold.